What's keeping you up nights if it's not the tariffs right now?
Nothing.
Really?
I mean, the tariffs
do you like
don't
this
bother.
market?
Oh, I love this market. I mean,
it's
how
not
can
expensive.
You not? No, it's about 18 times earnings. I mean, if you go back to the late 90s, now you're talking about PEs in the 30s. I mean, this is crazy. The one thing I really like about this market more than anything, I can go through the numbers. There is absolutely no euphoria in it. It's not like you get in a taxi in New York and the taxi driver's telling you what stock to buy. There's none of that. So essentially, once the euphoria comes into the market, then I think it goes the opposite way. But right now, the economy's doing very well, growing at 3%. Corporate earnings are up, cash flow's up, inflation's down. You name it. Earnings or salaries are up. Everything's going in the right direction. Okay. So these tariffs, they don't bother me because China needs us more than we need them.
David, what do you think?
Well, we're cautiously constructive on the equity market between now and year end because valuations are fine and the underlying economic fundamentals and earnings are strong. I do have some concerns on the trade front, particularly for 2019. I think the market has gotten a little complacent with a scenario in which we eventually make up with Canada and Mexico and you have a new and improved NAFTA, and then we settle things with the EU on industrial tariffs, and then we kind of all band together to force the Chinese to change their practices. I certainly hope it works out that way, but there's a lot of things that can go wrong in that scenario. And so I think this so-called trade war overhang will be with us for many more months. And while I don't think it will impede the market from some forward progress, it'll be a source of volatility from time to time.
Neil, I want to dig into this idea of no euphoria in the market. I get the comparison to the late 90s and that it's different here. We talk about the FANG stocks a lot. They've obviously been in a leadership position for the last couple of years. We've seen big runs in a lot of those names, a lot of talk about how expensive they've become recently, and we've started to see some weakness. Are you concerned about that?
No, because I still think there's a lot of value in the market. You just got to pick where you're going to pick the value. And essentially, most of the value is in boring stocks, boring companies.
Like what?
Look at Casey's General Stores. I mean, they got 2,000 stores. They're mainly in the Midwest. Their biggest product outside of gasoline is pizza. People actually go there to get pizza, which I mean, I can see going there and getting pizza. Sushi, I'm not so sure of at a gas station. But they got a low price to sales ratio. They got very good earnings. Their dividends very well covered. It can go. You can go ahead.
Well, I'm sorry. Are those mainly small caps, though, right?
Mid caps.
So
mid caps.
They're immune theoretically to the tariff wars anyway. They're more domestically oriented to begin with, right?
Exactly. Exactly. So when I look at stocks, I'm trying to buy value, so I won't pay more than 1.5 on a price of sales. That's in our Hennessy Mid Cap 30 fund. And so we try and look at, for instance, Trinity Industries. Nobody's really heard of them. I didn't really hear of them until they came into the portfolio, but essentially they go from making windmills to guardrails to barges to rails. They lease, they manage, they manufacture, and their earnings are very good with the low price of sales and dividends.
So David,